If you're here right now, either number one, you are concerned about market losses, or number two, you are worried about running out of income in retirement. If either one of those is true, then you are in the right spot. I think you're really going to like what I have to go over with you today. If you are somebody that is okay with volatility in the market, is somebody that is okay with high risk, then you are not in the right spot. This is something that you're probably not going to find very interesting. But for those of you that just want to make sure that you're not going to run out of income in retirement and you can take off income more predictably, still get enough returns to help hedge inflation, and then keep your overall fees low in your total portfolio, then you are in the right spot. My name is Brandon Lenhoff, owner of Lenhoff Financial, and I have over 18 years of experience in the financial services industry. My very first client-facing role was actually during the 2008 market crash, which was a super stressful way for me to get my start. As you can imagine, there were a lot of people calling in concerned about what was happening with their portfolio at that time. And people that did not have a good safe bucket strategy set up really suffered, especially those that were really close to retirement or in retirement. You know, those that were close to retirement, they had to push their retirement date out to get the income that they needed in retirement. People that were already in retirement, they had to learn how to live on a lot less or go back to work. I'm sure that's not what you want, and that's probably why you're here right now, and you're looking for the best way to help protect yourself from that happening to you. So I think what I'm going to go over today, I think you're going to like. First thing I'm going to do is I'm going to go over why we would set up a safe bucket strategy. I'm also going to go through the industry averages and what a lot of financial advisors, what they will do with a portfolio to set it up. And then I'm going to go over our methods as well. And then I'm going to go over a safe bucket product option. So I'm really going to go through a lot today. This is going to be a little bit longer video. And the reason why I want to do that is I want to make sure to save your time and then our time as well. We have a lot of people coming through that are very interested in these options. And rather than having you get on the phone with us and then finding out that, hey, this isn't something that you're interested in at all, I just thought it was best that we just put the information out there that we typically go through with people on the first call. And you're going to have a good idea of whether or not this is a good fit for you or not at the end of this call. And then from there, you can book a call with us where we can actually put together an option that's going to be best for you. So everything I'm going to go over today is very high level overview. Keep in mind, there are a lot of products and options out there. We are an independent brokerage. So what that means is we actually contract with any carriers that makes sense to have a contract with. If we find a company that has good product options for our clients, we go ahead and take out a contract with that carrier. And what makes us different than other agencies is a lot of other agencies are going to be captive. What that means is they can only offer products with one company. That's not always going to be the best situation for you. We technically work for you and not any one company. We don't care what company we go with. We just want to offer the best products and services for our clients. And the companies and products available that are the best for our clients can vary from month to month and year to year because these companies are always coming out with new options. So with that said, I'm going to go ahead and get into an overview of what we do on the safe bucket side. Now, keep in mind, we do partner with wealth managers as well. And so the wealth managers are going to handle the growth side of the portfolio, but we also take a team approach where my team, we really focus on the safe bucket side. And on the safe bucket side, you're going to get a good idea of how we do it differently than other financial firms. What we really believe in is, hey, every financial product out on the market can serve a purpose. There's really going to be nothing better for long-term growth than the market. As far as income goes, though, there's really nothing worse than the market. So we really focus on the side that's going to get you the best income. That way, anything else that you may have in the market, you're just not going to have to worry about as much because we know that your income portion of your portfolio is going to be figured out. So let's go ahead and take a look at these options. And then from there, you can book a call with us and see if this is a good fit for you. All right, guys, I'm going to go ahead and I'm going to go over this PDF here. And this will give us a high level overview of why we want to have a good safe bucket strategy set up. And then I'll get into a product option. So number one, what we're looking at here is just a pie chart showing 4 different quadrants of retirement. So top left-hand corner, you got pension and Social Security. Pretty self-explanatory, but pension and Social Security, those are going to be that monthly payment that's going to come to you for the rest of your life. And what's nice about pensions or Social Security is it does help you with budgeting. Most of us are used to having a paycheck. Virtually none of us are used to having this lump sum of cash that we just have, and then we got to figure out how to appropriately spend that down and not run out in retirement. And unfortunately, that's what most of us end up doing. We retire, and although we have that Social Security coming in, we've got this other lump sum of cash, and we got to, all of a sudden, after our entire lives never having to live like this, we got to figure out how to spend down that money appropriately. And that's where we come in and we can help. So pension and Social Security, that's going to help with the income. That's typically not going to be enough, though. Usually there's a good gap between what you actually need in retirement or what you're used to having as income in your working years and Social Security. And it's usually about 50% gap there. So where we come in is we help fill that gap. Now, the taxable income side. So this is going to be anything like a 403B, 401k, IRA, 457. There are more here. These are just IRS tax codes. They're all essentially the same thing. It's going to be pre-tax money, so you have not paid any taxes on this money yet. But when you start to take distributions in retirement as income, you are going to pay taxes at that time. Doesn't really matter which one of these that you have. If it's a retirement vehicle where you have not paid taxes yet, then what we do is we do a rollover from, say, a 401k into a traditional IRA. And then the underlying investment will be something that is more suitable for you. And the reason why we do a rollover is because we are going to avoid taxes on the rollover. So it's going to be a tax-free rollover, and we're going to stay within the same tax code that the IRS had in place that you were investing into. And then that way you're not paying this huge tax bill for rolling the money over into something else that's just a better investment option for you. Tax-free income. So this is going to be anything like Roth IRAs, municipal bonds, cash value life insurance. So these are options where you're going to pay your taxes first, and then when you get to retirement, you start taking income or start taking distributions to yourself out of the fund. It's going to be tax-free. So you're not going to pay taxes at that point because you already paid taxes before. So let's say you have a Roth IRA. What we do there is we just do a direct transfer into another Roth IRA. So that way we stay within the Roth IRA that you had set up, and we stay within that same tax code, and we'll still take those tax-free distributions for you. We're just going to realign your portfolio into something that is safer for you and makes more sense for your risk tolerance. Now, the last quadrant is going to be life insurance and living benefits. So things like heart attack, stroke, cancer, terminal illness, disability, in-home healthcare. In-home healthcare being the biggest one. You know, that is something that can really cause financial ruin for people in retirement. And so sometimes people want some additional protection against that happening to them. And we do have options to help you with that as well. But for today, we're really just going to focus on the safe bucket portion of the portfolio. The income gap. I touched on this earlier. The income gap's just going to be the difference between what you're used to making while you're working or what you need or want in retirement as income, and Social Security wages. We'll also include pension wages if you happen to have a pension. But whatever that gap is, we're going to help you fill it with a safe bucket strategy so we can more predictably get you the income that you need. That way, anything else that you may want to have in the market, you just don't have to worry about. Now, when it comes to investing, there's a lot of different options out there. In general, they're going to fall under two categories. Number one, they're either going to be like this blue line here, which is tied to the market. And with this, what is great about this is, especially in the early years of our lives, as we're saving up for retirement, we're going to be doing a lot of dollar cost averaging. We're going to be buying the lows of the market and catching some of the highs as well. And for long-term growth, there's really nothing better than the market. But for income, there's really nothing worse. It's really hard to predictably get income from something that's consistently going up and down. So typically, as we get closer and closer to retirement, we move more and more into safe bucket options, which is going to represent this orange line. The challenge there is just finding a good safe bucket option. You know, there's CDs out there, although the rates of return are starting to get a little bit better now. There are better options than CDs to get you a better guaranteed rate of return. There are bonds. Bonds are inversely related to interest rates, though. So as of this year, you know, as interest rates are going up to help hedge inflation, then a lot of bonds are actually coming down. And there's some other options out there as well. But what we really focus on are options where we're going to participate in portions of the gains of the market. So we're not going to get the full upswing of the market, but in exchange, you're never going to take any losses. And I'm going to get into that in more detail a little bit later. I know that sounds too good to be true for a lot of you, but it's real. There's a lot of companies that offer these options out there, but you're not going to lose your original investment, nor are you going to lose any gains that you ever have in these options either. You're going to lock them in. And not only that, but the options we're going to look at, they're not going to have an annual fee. We always look at options that do not have an annual fee for our clients. So we'll get into that a little bit later, but this is the basic idea that you either got options that are going up and down with the market or are varying, going up and down, or you've got options that are safer. Now, this really shows why you want to make sure to have a good safe bucket strategy set up if you want to have predictable income in retirement. So what this is going to show is 3 different people in retirement. As you can see, they were each exactly the same when they retired. So you've got Mr. Green, Mr. Blue, and Miss Gold. They were each 65 years old when they retired. They each had saved $1 million for their retirement. And they each had averaged a 6% annual rate of return over the 25 years we're looking at here between their ages of 65 and 90 years old. You can see that at the bottom here. Now, the only difference between the 3 is when they retired and how they were diversified. Now, Mr. Green and Mr. Blue, they were both in a variable option. So they were in the market at 100%, both of them were. Now, Mr. Green retired in an up market and Mr. Blue retired in a down market, which even though they had the same rate of return, they both ended up very different. So these rates of return, also, just so you're aware, came from real S&P 500 rates of return over the last 25 years. We just flip-flopped them. So Mr. Green retired in an up market, and so he was able to take out his 5% annual withdrawals. So each of them were taking 5% of their lump sum as income. So on $1 million, 5% would be $50,000 a year. Mr. Green had some big gains early on, which made it okay to continue to take that $50,000 a year as income. He never ran out. He did just fine, had plenty of money left at the end of his life. Mr. Blue, on the other hand, he retired in a down market. So he's more representative of people over the last 25 years. So he had some big losses early on, which is really a challenge when you're trying to take income. He probably budgeted for $50,000 a year of income. He probably talked to his advisor. His advisor probably told him, yeah, this is going to be the safe amount that you can spend down is 5%. But unfortunately, when you're selling off shares low that never have a chance to bounce again, you can run into some real problems. And he ended up running out. So this 5% spend down is something that has changed over the years. There have been some different theories from different financial advisors and different financial analysts. It's been 5.5%. I've seen some at 5%. There's what's called the 4% rule. Each one of those actually failed a lot of people in the last 25 years, including the 4% rule. And not only that, but people are starting to live longer too, which makes it even harder to figure out how much you can safely spend down. So one of the more recent studies I've seen is 3% spend down or 2.9% spend down, which if you take 3% of your lump sum, I don't care where you have it, you could put it in a can and bury it in your backyard and take out 3% of it every year. It's going to be pretty hard to run out of that, even without any returns. So basically what they're saying is, hey, this isn't really the best vehicle to take income from. It may be one of the best vehicles for long-term growth, but it is not a good vehicle for income. Now, where Miss Gold was at was a safe bucket option. And in safe bucket options, the theory there is you can spend down around 4.8% safely and not run out. And some of these options also offer guarantees on the amount of income you can take for the rest of your life. But the main idea is when we know you're never going to take a loss, you can just safely spend down more safely without running out. So although Miss Gold did not have as much money at the end of her life as Mr. Green did, she didn't have to flip a coin on whether or not she was going to run out of income. So that's the whole reason why we do a safe bucket strategy. And this isn't something that is necessarily new. Money managers, they try to do this as well. I mean, when I was with that broker dealer in 2008, 9, 10, this is what we did as well. The rule of thumb was, hey, let's take 100 minus somebody's age. And let's say somebody's 60 years old. 100 minus 60 gives you 40. That would mean you could potentially safely put about 40% of somebody's portfolio in the market. But then the rest needed to be in something safe. And obviously that could vary depending on a person's risk tolerance and some other things that we would go through as well with a client to determine suitability. But at the end of the day, financial advisors are doing this all the time anyway. It's just their safe bucket strategies don't always make the most sense. So a lot of times what they're going to do is they're going to put you in, say, a bond. Well, a bond, like I said, is not always 100% protected from market downturns. This year, interest rates on the rise to help hedge inflation. A lot of bonds are coming down. So you have people that are sitting in traditional money managed account that are not only down on their safe bucket side of their portfolio, but they're also down on their variable side or growth side of their portfolio. Not only that, but they're getting charged 1.5% management fee on average on all of it. Management fees from financial advisors are going to vary from financial advisor to financial advisor a little bit. They do have discretion on how much they're going to charge. And a lot of times that's going to vary based on how much money that you have with them. But on average, it's going to be between 1 and 2% management fee on all of it, including that safe side. So let's say your safe side of your portfolio with a traditional money manager is averaging a 3% rate of return, but we subtract out that management fee, not only from the growth side of the portfolio, but from the safe bucket side too. Now you're only getting a 1.5% rate of return in this example. That's not going to keep up with inflation. And not only that, but you're not protected from downside. So with our strategy and our idea is, hey, why don't we marry these products that are out there that do not have an annual fee? and let's marry it to what the financial advisor is doing. Like I said, we partner with financial advisors that help with the growth side. Being in the market, there is nothing better for long-term growth than being in the market. The challenge is just figuring out your income. So for the safe bucket side, rather than you getting charged by your money manager on the safe bucket side, I've ran into several clients that have had CDs with their financial advisor. A CD is a certificate of deposit that you can get with a bank. You can just go to any bank and get a CD on your own, but financial advisors are selling them to their clients and then charging a management fee on it. Why don't we look at other options that do not have an annual fee at all on that management, on that safe bucket side? And let's look at these options that you're going to participate in portions of the gains of the market and never any of the losses. And with that, we're going to get a better rate of return in the long run, and your fees are going to be much lower on your entire portfolio because there is going to be no management fee on what we do. So the safe bucket side of things, what we look at, we do not charge a management fee, and we look for products and options that do not have an annual fee. So with that, you're 100% protected from downside risk. Market has good returns, you're going to have good returns as well. And we can also get you more predictable income in this way as well. And I'll get into that in a little more detail here in a little bit. But with this, you can see how this could fare better than a portfolio that is set up like this with a traditional money manager. Why pay them a fee for something safe? Let them take the management fee on the growth portion of your portfolio. So hopefully that makes sense to you guys. One of the options that we use for this is going to be called a fixed indexed annuity. So now I want to get into what these are and how they work. I promised you I'd get into a product option. Keep in mind, this is just one example. There are a lot of examples out there, and there's a lot of annuities out there. A fixed indexed annuity is the option I like the most if you're trying to get the most growth as possible safely. And that might sound like a contradiction, but since you get a percentage of the upswing of the market, you can really get some good growth in good growth years of the market that you lock in and you can never lose. There are also what's called multi-year guaranteed annuities out there that I also like more and more these days. They're simpler. They work a lot like a CD with a bank, but they're typically going to be a lot better guaranteed interest rates. So we can always talk to you guys about that as well. But those are typically going to be 3, 5, and 7 year surrender charge period options. And what differs between those and a CD with a bank is you're actually going to have access to your cash during the surrender period. So during that 3, 5, or 7 year period, you get a guaranteed rate of return, but you're also going to have access to some cash as well during those years. So if you're somebody who really just likes, hey, what's the highest guaranteed rate of return that you can get me? Reach out to us and we can go over that with you as well. But this fixed indexed annuity can, if the market's doing well, get you even better returns. Now, out of all the annuities in the market, like I said, fixed index annuity is my favorite. There are what's called variable annuities out there. Variable annuities, I serviced a lot of those in 2008, 9, and 10. Challenge with those are they are going to go up and down with the market. Some of them have some downside protection, but there's generally a lot of fees built into them. So they're not my favorite. If you're going to be in something that varies up and down, you may as well just be in the market and have more liquidity of your money. There are what's called single premium immediate annuities. With those, you're going to be putting a lump sum of cash into an annuity with an insurance company. They're going to tell you, hey, we'll pay you this much per month for the rest of your life or for the rest of your life and a spouse's life. There might be a period certain that they might pay you. Even if you pass away within, say, 5 years, they're still going to pay your beneficiaries out for those total 5 years. But with single premium immediate annuities, you're giving the insurance company a lump sum of cash, and they tell you how much they're going to pay you for the rest of your life. I don't like those. Those don't make a lot of sense either. But fixed indexed annuities in general, the way that they work is, first of all, they're going to have guarantees. So there's going to be several different sub accounts that we can choose from in a fixed indexed annuity. And one of those is going to be a fixed account. So as an example, an annuity company may offer on their fixed rate a 3.5% guaranteed rate of return for the year. So if you put your money if you allocate into that fixed account, you're going to get a guaranteed rate of return of 3.5% for the year. After that year's up, you can reallocate to their other options. Their other options are also going to be indexed. So those indexed options, what's going to happen is it's going to give you additional growth potential beyond that 3.5%. So if you decide to allocate into the indexed options, we can get a percentage of the upswing of the market. So as an example, let's say that we put you into a S&P 500 index that has a 50% participation rate. And let's say the S&P 500 has a 10% rate of return for the year. What that would mean is if the S&P 500, let's say you put in your money today, and then 1 year from today, the S&P 500 went up 10%, you're going to get an interest credit of 5% for the year. That is locked in because you have a 50% participation rate, which means you get 50% of the gain of the S&P, and it's locked in. And these participation rates vary. Don't get too hung up on that 50% participation rate. Just an example, every company is different, and these things are varying from month to month and year to year. Same with this fixed rate. There are options that are paying quite a bit more than that 3.5% as well. This can vary again, month to month and company to company. These are purely just examples, high level overview that I want to show you. So every single year you can reallocate between the fixed account or these indexed accounts, and you can go back and forth and reallocate every year. And that is something that we go over with you every single year when we do an annual review. We talk to you about, hey, what's going to be the best option, and we help you make that decision. Now, again, these have protection from market downturns. So let's say you are in the indexed portion. Let's say you're indexing against the S&P 500. Like I said, you cannot lose anything. You're not going to lose not only your original investment, nor will you lose any gains. Income. So some of these options offer guaranteed lifetime income. So if guaranteed income that you cannot outlive is really important to you, then we can talk to you about an option that focuses on getting you the most income for the rest of your life. So not every one of these fixed indexed annuities is built the same. Every company is a little bit different, and every product can be a little bit different. Some companies really focus on the growth of your cash, trying to grow it as much as possible safely. And some companies really focus on the income portion, just trying to get you the most income that you cannot outlive. That's why we want to have a call with you, figure out what's most important to you: guaranteed rates of return, growth potential, or income. And we help make that decision with you. A death benefit. Every option we look at is going to have a death benefit. The death benefit is always going to be your account balance. So let's say you have $500,000 sitting in your savings account, and you're spending money down and down and down throughout your life in your savings account at your bank. And now you're down to $200,000 at the end of your life. Obviously, that $200,000 goes to your beneficiaries. Same thing with this fixed indexed annuity and any of the annuities that we personally show you. it's always going to be whatever your account balance is. So if you put $500,000 or $100,000 into this, and let's say that there's $50,000 left in your account upon death, that $50,000 is going to go to your beneficiaries. And not only that, because it's considered an insurance product, it's actually going to avoid probate as well, which is another great benefit of annuities. Now, every fixed indexed annuity is going to have a surrender charge period. So now I'm going to go over an example. Keep in mind, this is just an example. There are a lot of different ways that these are set up, but I'm going to go over a surrender charge period. So in order for the insurance company to give you the types of returns that they can give you in these options, they do need to give you limited liquidity during a certain amount of time, because they need to have time to go make more money with your money. So they all have a withdrawal charge period. Typically, you're going to see companies have either a 7-year, a 10-year, or a 14-year option. And a lot of the companies offer all three of those. So the reason why a person might go with a 10-year or a 14-year surrender charge period is just going to be because there can be greater growth potential in the longer that it goes out. So the insurance company might give you higher participation rates. What I mean by that is bigger chunks of the upswing of the market the longer that you go out. But some people just aren't comfortable with having a surrender charge period that lasts 10 or 14 years. So they end up going with, say, a 7-year option. And that's okay. It's whatever your comfort level is what we help you out with. What I'm going to show you here is an example of a 14-year surrender charge period. I want to show you worst case scenario. Keep in mind, this is not every annuity, and there are other options out there. Just want to show you kind of worst case scenario, what they can look like. Now, during your surrender charge period, the types of options we look at for you definitely have free withdrawals during the surrender charge period. So you can see up in this top left-hand corner, free withdrawals. Typically during the first year, you cannot access any of your funds without a fee. So we want to make sure when we talk to you that we determine what amount makes the most sense for you to move over and have income from another source during that first year. But after year one, you're going to be able to access a percentage of your account balance. So in this example, this company is going to give you 5% access to your account balance every single year during that surrender charge period. Now, a lot of companies, this is going to vary. So it can be from 5 to 10% access per year that you can access during that surrender charge period. So as an example, let's say you have $100,000 that you're putting into a fixed indexed annuity, and let's say they have a 5% free withdrawal. And let's say that you have a 14-year surrender charge period. In year one, you do not want to take any money out, or you would be subject to a withdrawal charge. Starting in year two, with this 5% withdrawal, if you have $100,000 in your account, you could take out $5,000 without any fees. There's going to be no fee associated to it. In year two, in year three, if you still have $100,000 in there, to make it easy math, you can access another $5,000 or 5% of your account balance without any fees. Once you are completely out of the surrender charge period, in this example, it would be 14 years. So once you are done with those 14 years, you can then access 100% of your funds. So you can still keep the annuity if you like it and you like how it's performing for you, like the benefits of it. It's just at that point, you could then access 100% of your funds without any surrender charges, no annual fees or anything. So if it was a 7-year surrender charge period, it would be for the 7-year period that you could access 5%. And once you get to the 8th year, you could then access 100% of your funds. If you have a 10% free withdrawal, then that just means you could take out 10% of the balance. So if you have $100,000, you could take $10,000 out per year. Hopefully that's very clear to you. Now, this withdrawal charge schedule In years 1 through 14 in this example, you can see that they start higher in the early years. So in this example, it would show 14.75% in year 1, and then it goes down by about 1% per year until you get out of the surrender charge period, and then you have access to 100% of the funds, like I said earlier. So the longer you go out, if for some reason you have to access more funds, your penalty will be less. So, but let me tell you how this works. So let's use the same example. Let's say you got $100,000 in there and you take out 5% in year 2. $5,000 goes to you free and clear, no charges. If you go to 6%, so you take out $6,000, well, that first 5% is still free. So the $5,000 is coming to you with no charges. That additional 1% or additional $1,000 would have a 13.75% charge. So you only get charged on the amount that you go above and beyond that free surrender amount. So when we design these for you, we always want to make sure that we keep liquidity in mind. Keep in mind, like I said, there's a lot of different products and options out there that offer various amounts of liquidity. So we just want to pick an option that's going to make the most sense for you, that you know you'll never have to go above that withdrawal amount. I personally don't see this as a big deal. We already talked about earlier that, hey, if you spend more than 5% down on your money, you're probably going to run out anyway, or a lot of people did in the last 25 years. So if that's the case, having 5% access to your funds during the surrender charge period, not a big deal. 10% access to your funds during the surrender charge period, definitely not a big deal. If you're spending more than 10% down on your funds during retirement, you're just going to run out. So that's how surrender charge period works. The last thing I want to show you is just how returns can work. I want to make it very crystal clear. I know that sometimes people think this is too good to be true, and they think that you have to have a downside if you're getting these kinds of returns, and it's just not the case. So I want to show you how this can work. Now, this is an example that I pulled. Keep in mind, it is just an example. I'm not guaranteeing any of these returns. We do not know what the future will hold. But I did pull this from one of our companies, and it shows if you would have put $250,000 into this account 10 years ago, exactly what your returns would have looked like. So this is based on the last 10 years growth. I don't know what it's going to look like for you in the future, but over the last 10 years, if you would have put 250 grand in your account 10 years ago, this is how it would have looked growth wise. So you can see in year 1, got that 9.26% rate of return, year 2, 20%, year 3, 8.86, and then you can see in year 4, 0% rate of return. So that means it was a year that the market went backwards. But as you can see, this $250,000 on the right side of the screen under account value here grew to year 3, $356,874. In year 4, even though the market went backwards and you didn't get any gains, your account did not go backwards. So your account stayed right where it was. It stayed right at $356,874. And then when the market starts going up, you are going to experience those returns again. So again, you always, not only can you not lose your initial investment, you cannot lose any gains that you have either. In this example, I did not take out any withdrawals. I just wanted you to see how this could grow. So if you think that this is something that makes sense to you, go ahead and book a time with us. There is a link below where you can book a time with us. I hope that this gave you a good overview. There are a lot of options out there. This is not everything, but I hope that this gave you a good idea of how we can help you set up a good safe bucket strategy. Again, like I said, we just want to keep your risk tolerance right where it needs to be. We want to get you the best returns possible. We want your fees to be as low as possible, and we want you to have more predictable income in the future. So go ahead and pick a time that works best for you to have an initial call with us. So the process, if you book a call with us, will be this. You're going to talk to one of my initial call people first. All they're going to do is gather some additional information from you. It takes about 5 to 10 minutes to get through that call. We keep it really brief. It's just to gather some information to make sure that we're a good fit for you. And I can also start putting together a plan that's best suited for you in your situation. So that's going to be the first thing. Then what's going to happen is they're going to pass that information along to me, and they're also going to book a follow-up call with me once I have some time to put together a plan for you. So go ahead, if this is something that is interesting to you and you want to learn more about, go ahead and click the link below. Please just pick a time that you know will work for you. We do have a lot of people that are coming through, so we just want to make sure that check your schedule, make sure you don't have any doctor's appointments or soccer games or whatever else going on in your life. Please pick a time that you are 99.9% sure will work for you. And then we will make sure to talk to you on that call, and we will put together a plan for you. Look forward to talking to you soon.